Big week of earnings ahead. United Airlines, Netflix, Tesla, IBM, Procter & Gamble, 3M, Intel, and dozens more all scheduled to report results. Joining us now for a look at what to expect is Nick Raich, the Earnings Scout co-founder and CEO. Nick, great to have you with us.
Morning. Thanks for having me.
We've had some earnings come in, mostly from banks and financials. But what are you expecting for the next batch out next week in terms of revisions and just, whether or not they're going to beat?
Yeah, we looked at it. We have just under 75 companies reporting in the S&P 500 next week. What we looked at is their revisions last earnings season. About half of those companies had their estimates cut after reporting by about 1.5%. So our bogey for next week is we want to see less than half of them cut estimates. That would be an improving trend by less than 1.5%. If they can do that, that's going to put us on a path for improving trends for the earnings expectations. And that's what the market's been anticipating ever since the end of October last year. And that's what we're hoping for that we measure next week.
Do you think that this will be an earnings season where we're going to see full year outlooks raised in the end? Or do you think companies are going to toe the line and play cautious? I mean, already, as you mentioned, earnings estimates have been revised lower in general by analysts. So the expectations are lower. Do companies take that and say, you know what, let's just keep it there? Or are they going to raise, do you think?
We don't think they're going to raise. The market's been pricing in that they're going to raise, but we don't think to stay on an improving path of earnings expectations, since we saw estimates being cut at increasing rates last earnings season, falling by about 2%. If they only fall about 1% this earnings season, that's positive to us, and that's an improving path, and that's what we need to see consistently to have a sustainable bull market. So we don't think we need to see raised estimates for stock prices to still go higher here. They just have to be cut than they were at a lesser rate than last earnings season. That's what we're trying to hope and measure this earnings season.
Nick, a lot of focus on exactly where the earnings growth is coming from. I mean, the largest stocks that were, accounted for most of the upside in the market last year, yes, their valuations were lifted, but they also seem like they're going to be driving the majority of the absolute dollar value of profits this year. Where do you see the distribution shaking out?
Yeah, a lot of people think the Magnificent Seven are in a bubble, but they literally last year had some of the best positive revision momentum there was, particularly a name like NVIDIA, which was just phenomenal. The growth is still coming from artificial intelligence. One of the early reporters last month was Micron Technology, and they raised their estimates by 50% last month. So one of the early reporters. So we're definitely seeing growth still with anything regards to artificial intelligence, and that's still a business that's, we think, in its infancy, early innings of stage. So there's probably a lot of room to run up with AI-related names.
And in terms of sectors with the lowest expected growth, Nick?
The lowest expected growth, where you would think, that's going to be in the, the defensive areas, the staples, the healthcare, utilities. The healthcare was beaten up stock-wise last year, but that was where the lowest growth is. And if we do see any kind of trend where estimates start to get at increasing rates, those defensive areas will actually be cut at lesser rates. And so that would be a good thing if we go that path. But what the market's anticipating is not that. The market's anticipating earnings expectations are going to improve here, and the Fed's going to pull off what we call the hat trick: defeat inflation, avoid a recession, and dish out rate cuts.